Welcome. My name is Sasha Moore, and we're here today with Chris Levy and Ben Lacey, both SMSF audit experts and partners at Aquila Super, to hold the inaugural SMSF Tech Talk live webinar. We're holding this webinar to provide SMSF advisors, accountants, and auditors with real-time answers to common technical questions across a broad range of areas. We've received several pre-registration questions, which we'll start with, but in the meantime, please be sure to place your questions in the live Q&A section of today's Zoom, and we'll answer as many of these as possible. So let's jump straight into it. We're going to start with a question that's come from Rob. How much notice should we take of the new Divisional 296 tax if it has not yet been placed before the Upper House?
Yep. Well, look, great question, and we thought we'd bat off an easy one to start, Sasha, as we discussed. Look, obviously we don't need to worry about it as much as we used to, but it did raise an interesting point in that, like, even though we don't, the unrealised gains thing seems to have gone away. What has actually changed for the audit? And the reality is not much, because valuations, the emphasis of the ATO on evaluations has been so significant, that's not going away. And we'll be talking about some valuation stuff later on. So yes, we don't need to worry about unrealised gains, but valuations are still very much going to be probably the big audit concern going forward.
All right, thank you. Well, we're just going to rapid fire through as many questions as we can, because it's great to see already so many questions are coming through the live chat function. So we've had a question, a pre-registered question from a Krish, who's asked, how do trustees ensure compliance with SIS Act if crypto is held in cold wallet and difficult to confirm ownership?
Okay, I'll take this one. Okay, so just for a bit of definition, a cold wallet is basically just an offline storage device for a trustee's keys that they will use to be able to access the cryptocurrency and transact in it. Okay, so what's interesting about crypto is the asset itself is not stored on this device, this offline device. The crypto is on the blockchain online, but the value of the cryptocurrency for the trustee and the fund is intrinsically linked to the trustee's ability to control it. And because of the infrastructure of cryptocurrency, it doesn't have a holding title or a legal title associated with it. So it can be a little sort of complex to audit, but just generally speaking, for an audit, what we're going to ask for is the blockchain address that's associated with the fund's wallet. Okay, an auditor will take that address and put it in a blockchain explorer. And from that, they're going to be able to basically confirm the existence of the cryptocurrency on the blockchain, all the transactions associated with that wallet, and the balance of the crypto at year end. So from a SIS compliance perspective, we're going to be looking at the balance. If it's a readily traded crypto, let's just say it's Bitcoin, it's very easy to get a spot price at 30th of June so that we can confirm that the crypto is valued at a market value in the accounts. Importantly, around the transactions, what we do see is sometimes trustees are not quite aware that we can see everything that's happened on the blockchain, and they might be unintentionally sort of using their wallet for personal crypto holdings, and there might be trades in and out that aren't associated with the fund. So that's something to look out for, maintaining a separation of assets. Also, if crypto is being transferred onto the blockchain, we can see the source of that. And if that's coming from a personal wallet, for example, you've got to be careful, because cryptocurrency is not an exempt asset under Section 66, and you can't acquire cryptocurrency off yourself. Now, obviously, that just covers the existence of the cryptocurrency, but in relation to the actual the holding and how do we confirm that there's ownership there, part of it will be an acknowledgement of trust, where a trustee basically is making a declaration that the wallet and all the associated cryptocurrency on the blockchain there is held for the sole benefit of the super fund. Okay, but as I mentioned earlier, it's about the control that really is what gives the crypto value in the super fund. And so to actually determine control, that that's more complicated. It might be a trustee basically coming in and showing an auditor or an accountant that they can plug in their device and they can actively transact in the cryptocurrency. Some trustees might not be comfortable with walking around with their keys and that kind of stuff. So there are some other ways where certain wallets may allow you to leave messages that you can see when you check the blockchain through the blockchain explorer. And so an auditor might give them a phrase or something, and the trustee can put that message in there. And then once you can see that they've put the message in there, that sort of gives you comfort that they've got control over it. That's very broad and quick. That was pretty long, sorry, but yeah, that covers it, I hope.
Thank you, Ben. We'll move to the next question that's come through from Arthur. When commencing the first member pension during the year, what level of detail is required to support the asset allocation?
Yeah, I saw this come through. I wasn't entirely sure what the question is, but I think it relates to what type of, how much work does an accountant have to do where a pension commences in the middle of the year? And unfortunately, you do have to have a proper members balance. You do effectively almost have to do an interim set of financials to nail down what is the members balance as at that date, including market, any sort of market revaluations. You can't just rely on the 30 June. So you have to sort of bring that up to account. So look, it's annoying, but I mean, those are the rules. I guess that most sort of super software that does cater for that. It lends itself to that, provided the market values are available. But there is an element of just hassle and additional work in getting those member balances, and I guess that's one reason why you see so many pensions start on 30 June or 1st of July. It's just because all the work's already done. And I saw an instance actually just last week where all this work was done, and they had a members balance to kick off a pension, and there were some rollovers and things. And then subsequent to that, sort of 8 to 9 months after that, they realised that the contribution that had been put in previously was treated incorrectly. And the accountant was just given the wrong information. It was sort of this contribution. It was a CGT rollover, and it messed things up, which is unfortunate. So yeah, you've got to watch out for that. But yes, there is, where you're starting pensions and do benefit payments in the middle of the year, you are required to do interim financials effectively.
And to clarify, interim financials don't need to be audited. It's just more about ensuring that you maintain that sort of file note to confirm that you've got accurate pension values, and also the taxable and tax-free split is all accurately calculated.
Okay, great. Thank you. So we've had a question come through from Wally. I have clients in rural New South Wales that have farms that are owned by the SMSF and leased to a related party. What's involved?
Okay.
Yeah, you take it, Ben.
Well, I'll start. Well, let's bounce off each other a little bit.
Yeah.
Okay, so just as a starting point from an audit perspective, if any lease with a related party tenant is an in-house asset, that's the starting point. Now, within the legislation, there is certain exemptions to leases that don't have to be counted towards your in-house asset value. Okay, so one of those is if you've got a lease with a related party and the property is business real property. Now, when you're talking about farmland and it being business real property, just because it's farmland, if we're just talking about the land, doesn't necessarily meet that definition. It needs to have like an active business role where, I don't know if it's like crops or farming or the like. I mean, I would just assume if you had a hobby farm with a donkey and 2 ducks, that's probably not going to do it. So that's the first protocol, just to ensure that you're meeting that exemption. And then being a related party lease, you're going to have a written commercial lease in place. Under the legislation, it's actually that it just needs to be a lease enforceable by law. It's very hard to support that and prove to an auditor if you have a verbal arrangement that it is legally enforceable. So that the recommendation would definitely have a written lease in place. And then we would also be, depending on when the lease started, wanting evidence that the agreed rent or agistment or whatever the lease arrangement is at a market rate. It's really a good idea to speak to a objective third party like an agent who understands the region and farmlands and that kind of stuff to kind of support it. And Chris, I'll let you go in relation to maybe farmlands and market value and the complexities around that. Yeah.
Yeah, absolutely. These more unusual type properties and things, whether it's regional areas or the property is quite unique, and I mean this is where a lot of these problems are arising. I guess the thing is that one of the issues of farmland is that in particular areas there's not a lot of sales. These farmers sit on this land for generations, and there's not a lot of transactions, but you can get it, and I guess we sort of lean onto the tax office, the guidelines, and they talk about comparable properties and that if you are basing the valuation on a solid methodology that's sort of provable, and there is some element of comparable sales, what you can actually do, what people have done is they'll look at a particular area to find a sale, and if they can't find one, they'll just go a little bit further. And the good thing about farmland in most instances is that a pasture is a pasture. Now, obviously there are some next to a creek is more valuable than one out in the middle of nowhere, but you can actually get it's available to or you can find actual sales of farmland, and you per hectare, per acre, whatever it is, and then you can translate that to the for the valuation of farmland. So there is usually information there. It can be tricky. You do have to potentially look a bit more further than you might otherwise want to would be sort of happy with. Well, there's an asterisk to that, and the asterisk relates to where you have various structures on the property. So it's not just pasture. That can be a bit tricky, and we saw one instance where a real estate agent actually sat down and sort of said, well, look, this is the sort of construction cost of a shed like this, and then it's 20 years old, so we'll depreciate. So there was a methodology there to actually come up with a market value, and if you sort of step back from that, you go, yeah, this actually makes sense. The land has an inherent value which you can get from sort of these comparable sales, these other sales, and then the shed itself has value as well, and they can work that out using sort of typical construction costs. And in many instances, you can actually get that. It's publicly available. Quantity surveyors and things actually have that type of information. So the combination of the two, you can get there. Granted, a little bit of work. We accountants, we're not used to having to jump through these hoops for these sorts of things, but you can actually derive or a sort of a solid valuation that would probably stand up to ADO scrutiny.
So if I can just jump in, I would say that with unique properties or very difficult to value properties, it would be best practice to get a good quality valuation report in place, and then in effect supplement it if they don't want to get them regularly with this kind of like sales data and try and kind of build out the valuation and extend your reliance on it. But like having 10 years of a property or a piece of land, and you're just like, we're higgledy-piggledy trying to put stuff together. Once it goes on for a little bit, it can be hard for an auditor to go, is this sufficient? So it is really a good idea to have like good data points that you can kind of bounce off. That's sure. Can
I just bounce off that as well, Ben? Yeah, that's a given. And I think for any business property with farmland, industrial, whatever, yeah, absolutely. Our position, the position a lot of accounting firms are sort of coming to is, just as a matter of course, they will go and seek a detailed valuation every 3 years. Now, the whole 3-year rule thing, where you could rely on that for the whole 3 years, well, that's obviously gone. But at least, as Ben, you say, you've got those data points, and then the intermediate things, well, then you can use comparable sales to shift that value. But at least, having a sort of detailed work done by a professional every couple of years is critical. I think, with the ATO's mindset, absolutely, yeah.
Thank you so much. Let's move on. We've had a question come in from John. How is a reserving strategy accounted for in the books of an SMSF and in the tax return for the same SMSF?
Well, look, I mean, for the accounting side of things, obviously you have to show the contribution coming in, and it'll go, the other side of it will go to reserve. The members' statements won't show that contribution being allocated in a particular financial year, but in the tax return, the same sorts of things happen. You need to reflect it coming in, but it's not actually assigned to a member. Now, as an auditor, we'll need to look at the relevant sections in the trust deed to make sure that the fund is able to do a reserving strategy. There's a tax form that you need. I think it was a request to adjust concessional contributions. We'll need to see a copy of that to show that you've sort of done that. And then also the bank statement in July, it should be in July, where we can actually see the or not so much the bank statement, but just the minute in July where you can actually see the contribution being allocated. So yeah, and look, once we get those, we're sort of pretty happy with it. Yeah.
Okay, great, thank you. We'll move on to a question that's come through from Vincent. He has a scenario that a fund has closed in 2025. It transfers out early October 2025. The interest earned for 2026 is $220. The trustee's age 50. Is 2026 required?
Well, I guess it depends a little bit. If we're like, they're saying the transfers out are in October 25, the assumption being that these are rollovers out to other complying super funds, which means SuperStream is going to be something that we need to be considering, which is a big compliance requirement that we need to sign off on. Now, if we're talking about, okay, a scenario where they've divested all their assets and but they've still got all the benefits sitting in the fund, and we could say, let's say $500,000 or $1 million sitting in a super fund, and then they're waiting to transfer it out, it's probably like recommended that you do the 26 audit and have it like that. I'd say that there's scope. I mean, generally, I think there's scope for an auditor to go, I'll do the wind up at 30th of June 2025. If we're talking about most of the transfers have happened in the prior year, you've got a little bit of leftover, like just do the outstanding checks and push it. But if we're talking about significant rollovers, just because of SuperStream and that kind of stuff, it just is kind of a no-brainer that you just have to do that 26 audit. It's probably going to be a pretty simple audit, but yeah. What do you reckon, Chris?
Yeah, no, spot on, Ben. Look, I would go a bit further and say, I wouldn't say recommended. I'd say that the ATO would expect you to do that. If you've got a sizable chunk of the fund that still exists after 30 June, and definitely in the case of a rollover, if it's been paid as a lump sum, to say, these old retirees, they're winding up their fund, maybe there's an argument, but if there's a significant amount that's yet to actually leave the fund, I believe that you would be expected to do the financials, the tax return, get the audit, even though, we had one 2 months ago where it was like 1 week. They did it the week after 30 June, and it killed us having to spend money on it. Like the trustee had to incur these additional costs, and that's it's not ideal, but there is a requirement. Now, that conversely, if that big chunk is left before 30 June and there's this tiny tail in, they sort of go, oh, we've got a few accounting fees to pay, or we're keeping the bank account open because there's a refund coming in. Like, look, those ones, I guess there's an argument there to say, yeah, look, you can effectively wind it up on 30 June, and through outstanding checks and things, you can say, well, all right, we'll bring the balance sheet down to zero and effectively wind the fund up at 30 June. And from an audit perspective, we will want to see bank statements after 30 June, just making sure that what you are saying in the financials at 30 June actually has happened. So, yeah.
Yeah.
Great, thank you. So we have a query that's come through from Natalie that she's stated, ECPI, when member dies and death benefit is not paid for years due to a contested will, including crypto and platform security.
Okay, we'll probably bounce off each other a bit on this. Just like the actual kind of audit requirement when death occurs, okay, when there's a death in the fund, okay, death is a compulsory cashing event. Okay, that means that you basically have a choice. And that is either the benefits of that member get paid as a death benefit pension to a dependent or a reversionary beneficiary and that kind of jazz, or it has to be paid out as a death benefit lump sum. Now, in the regulation, it's about paying out the death benefit as soon as practicable. Now, that's not there's no defined time frame there. I know the ATO did previously have on their website this kind of reference to 6 months, which, I mean, I think the industry as a whole, that's a pretty tight time frame after somebody dies, in my opinion. But they have removed it, I believe. Now, what we're talking about here from Natalie is a situation where seemingly it's the death benefits can't move because there's a legal situation with a contested will and the like going on. I think that we're, as soon as practicable and a court sort of holding everything up, those kind of things are obviously at play here. And I think, you know, maintaining appropriate records of what the situation is, that the people acting for the deceased and the trustee are, you know, trying to get the death benefit paid, but it's kind of held up. I think like maintaining those records is probably a good idea, but I would put it that if we're talking about a really significant amount of time, we're not talking about a year and a half or 2 years. Let's say we're talking 3 or 4 years and it's just at a standstill, and we're talking about, let's say, millions and millions of dollars. Okay. Although I don't think the ATO are actively going to try and go out and take people out for death benefits, it's not their goal. Okay. They also don't want death benefits to just be sitting in a concessionally taxed environment for years and years and years. Now, in a situation like that, it probably would be advisable, though I'm not giving advice on this, but it's like advisable for maybe to do an early engagement with the ATO where you basically move first, you go and speak to the ATO and basically go, this is a scenario. We just want to let you know that the trustees are trying to pay this death benefit, but due to this court action and because of this contested will, they can't pay it out. We just want to let you know that we're not just like leaving it here. Now, like, again, I don't think the ATO are necessarily going to come for them, but it just might be an idea to kind of have that dialogue and be the first mover in that situation, because certainly what you don't want is the ATO to turn around and basically just go, well, we've just seen these benefits sitting in here and you're going to lose the concessionally taxed concessionally taxed death benefit treatment. I don't know, you were shaking your head, Chris. Have I gone too far?
Yeah, I think what's more important is to actually have some substance behind the reasons for the delay in paying it out. I think once you get to sort of about 3, 4 years, you're right, you might want to reach out to the ATO at that point. But I think what's more critical is to actually have documentary evidence to if they say, the ATO says, hey, what's going on? You've been sitting, we haven't seen any movement on this for 4 or 5 years. You can say, well, here you go, bang. Here's the legal correspondence. And in the same vein, we as auditors will be expecting that as well. Once you're going over sort of a year, getting into 2 years, and there's, and you haven't paid it out, and you say, oh yeah, it's not practical. We can't do it. In the instance that Natalie's raised, where because of legal disputes, and I've seen this actually happen, there are actually question marks about who is legally entitled to make a decision about a death benefit. If someone just did it, it could end up being an invalid trustee decision, because there is a legal question mark as to who is actually the legal personal representative. They're conflicting positions. In that sort of instance, it makes perfect sense why a death benefit can't be paid. And I think the ATO would be that they would understand it. I'm just going back to your comment before, Ben, about them removing the 6-month sort of time frame from their website. Is because there's a large degree of subjectivity with this, and there's a whole bunch of different scenarios. So I think that the situation that Natalie's got is perfectly okay, but we as auditors will have to, after 2 years, or even 12 months, we would probably want to see some of that correspondence. Now, there was another situation I had about a year ago where this thing had dragged on into the, it's getting into the 2nd year, maybe I think the 3rd, and the accountant said, oh yeah, they just don't want to sell the property yet. And so they're not happy with the market. And that's the sort of stuff where you're like, oh no, that would end up being a breach, So yeah, there's different things, but if you've got a legitimate reason, you know, we had another one where the surviving spouse, she, you know, the death of her husband, you know, she had a mental spiral, and you know, if you've got a decent reason, you just need it documented, you know. So yeah.
Thank you. Well, we'll go to the last of the pre-registered questions, and then we'll throw to some live Q&As. So the question from Daniska has come in: how should an auditor verify the valuation of an unlisted investment when there is no active market or independent valuation available?
Yes, this is probably been one of the biggest bugbears in the last two years, because there's a lot of funds that invest in this type of investment product. Yeah, and you know, a lot of these sort of startup type ventures, you know, private equity type things, where the information that's available is just, it's almost non-existent. What is available is really opaque. You can't, you know, they've got the fund is invested in a company, but then that company is invested in another one, which is supposedly invested in another. You know, it's just, there's no information available, and there's, you know, even having financials and things isn't enough, because you just can't dig down to you know, what's actually happening with the investment. Yeah, look, I mean, if there's a capital raise, look, obviously you know, you've got something there, or there's one looming, that, you know, that could be useful. Sometimes we get these investor briefings from the sort of the managers, and they talk at length about what's happening with the investment and what they think it's worth and the reason. Look, that's great if you can get that. Unfortunately, that seems to be more the exception than the rule. A lot of these, you know, private equity types keep their cards very close to their chest and don't want to sort of say anything, except of course everything's great, so don't worry, investor. However, unfortunately, there's a point where the lack of information is just so severe that you just have to put your hands up and say, look, sorry, you know, it's a qualification, you know, and a contravention of 8.02B, and look, it kills me having to do those, because, you know, the trustee hasn't actually done anything wrong, but you know, the ATO are quite correct. They haven't, because of the nature of the investment, they haven't actually met the expectations of that valuation regulation in the SIS Act. Yeah, what do you think, Ben?
Yeah, I mean, like, again, it's like, this is a very difficult question to answer quickly, because when we're talking about unlisted entities, I mean, it could be like a property trust, where, you know, you can dig into things like a net asset valuation and that kind of stuff. But if it's a trading entity, or as you say, venture capital, those things can be really difficult. And I mean, obviously the clashing here is that you have companies that are not required to have a market value for shares, and the directors are like, we don't need to do this in our industry. And you have a little super fund investor and their little auditor with their hat on coming in and going, we need a market valuation. And they're like, well, it's not, it doesn't work. So, I mean, you know, arm's length trades are always the question. If there's no trading going on, if it's a business entity, I mean, there is a little bit of potential, if it's an industry where potentially you have evidence of another valuation for a similar company in that industry, potentially being able to piggyback off that. But look, the reality is, again, we can't really go into all of it here, but the reality is, I think it's a conversation that people need to be having with their trustees now, which is like, in the past, it's just like, is it compliant to invest in an unlisted entity? And it's like, in general, if you're not controlling it, it is totally compliant. But now the question is it not only is it compliant, is there control issues and that kind of stuff, and is it a good investment for the fund? But are you comfortable? Like, do you know if the company is going to provide evidence or sufficient evidence to support what the share price of an entity is, for example? And if not, are you going to be okay with the fact that there's potentially going to be insufficient evidence and an auditor may need to qualify? You know, I don't want to. Yeah, I mean, I don't really want to talk for the ATO here, but I mean, it's certainly something I was reading today, that there's been a big jump in Reg 802B ACRs being lodged. And this is really in line with the fact that the ATO have made it so clear of what their expectations are around sufficiency of evidence. And that's probably why some of you guys are on here now going, why 5-10 years ago my auditor wasn't making this noise and now he's making this noise. What's going on? And it's, well, auditors are being reviewed by the ATO, and the ATO have absolutely put it out there. You need evidence as close as 30th of June. If it's a complex asset to value, you might need to speak to a professional valuer, which is definitely not going to be cost effective for some trustees to get a business valuation, for example. So, yeah, there you go.
Okay, thank you. Well, let's just quickly jump to some of the live Q&As. So Maria has asked, referring to Section 296 tax, if I take out funds prior to 30 June 2026 for total super to be below 3 million, will I need to pay the extra tax?
I guess it depends. I mean, it's just a standard benefit payment. The extra. Oh, I see. So well.
It hasn't gone through.
It's kicking in on 1 July 26. So there is no, so Div 296, the new version, and again, I don't think legislation's come out yet. The new version won't apply for this financial year. If going forward, if you do, if a client does take benefits out when 296, this new version is in place, then for the period where the member has more than $3 million, you'd have to think that yes, they will attract extra tax. But look, I mean, until we get legislation, we don't know. It's gonna, the software is going to do some very serious heavy lifting for this, I'd imagine.
Indeed. We'll go slightly over time just because we've got some great questions which have come through. So we've had a scenario presented, and Ben and Chris, it might be also easier if you have a look at this one in the Q&A function as well. A calculation was presented to a client approaching age 75, covering the next 2 years worth of CC and NCC, but she misinterpreted this and put the entire amount of 540,000 into the super fund in year 1. Can we rely on the restitution law and argue that it was an admin error and withdraw the contribution that was meant for year 2? Will a minute explain and suffice?
What do you think, Ben? Have you had much luck with accountants and the restitution law?
I mean, I was at a seminar recently, and the law of restitution doesn't preclude people from the SIS Act. So if a deposit is put into an SMSF and at the time it was a contribution, you can't change your mind after the fact, after it goes in the eyes of the ATO. Okay, it is what it is. It goes in, and then you basically need to go through, if there's excess contributions or any of that kind of stuff, you just go through that process. I can't imagine there's any way that that you'd be able to put it in there and then just trying to journal it out or anything like that and pay out the money. I think it's still going to result in some form of audit issue. What do you reckon, Chris? Yeah,
it's a bit of a Hail Mary. You could try. You could absolutely try. I've seen the ATO tick off on some incredible things and said, this is all fine and you can do that. So, give it a shot, but I'm not optimistic that they'd accept this. Yeah.
Thank you. We'll go to a quick question from Peter. At death, can the tax-free balance of an SMSF be released to the executor, and is it subject to probate?
The tax-free balance of a fund. Well, I mean, member benefits can be paid to the estate, and then be sort of subject to the will, and the executor can actually determine what happens to that money. But the decision to flick it across the estate is either done, or it's sort of written into some sort of binding death benefit nomination, or the legal personal representatives, plus the surviving trustees, make that decision to put that money into the estate. And how it's treated, how the tax treatment of those benefits once it goes to the estate, depends on which beneficiaries it ultimately ends up with. So, yeah.
Okay, thank you. And Natalie's, who you've commented on previously, she's come back with 2 other additional questions, saying, can we still apply ECPI for 2 years after death? Also, on this, how important for an auditor witness VDBNs?
Yeah, look, well, I mean, in terms of the ECPI, I mean, with just thinking back to that other scenario where there are problems in actually, making a death benefit, as soon as is practicable. Yeah, the ECPI just continues. It's which is one of the reasons why the ATO wants out of the fund. If you've got a solid reason for it, it'll just continue. In terms of binding death benefit nominations being appropriately witnessed or just valid, generally speaking, I mean, look, we don't really look at binding death benefit nominations while the member's still alive. It's not in our sort of wheelhouse. Where it obviously becomes relevant is when the member dies, and the trustee is relying on a binding death benefit nomination. It's critical that it actually be legally valid, and we will look at that. I will say though that it's less of an audit issue because if it's not valid, then it's just a death benefit nomination, and in that sort of instance, the surviving trustees / legal personal representatives can effectively pay it out to whoever they want, subject to eligible beneficiaries. So it's not having an invalid binding death benefit nomination is not actually a breach per se of anything in the SIS Act that an auditor would be worried about. It's still potentially an issue to bring the attention of trustees, but it's not SIS Act type concern.
Yeah, from an audit perspective, our main concern is definitely about that the appropriate legal personal representative is acting for the deceased up until a death benefit is paid. And the reality is those guys are the ultimate decision makers, the trustee, and we definitely should see a binding death benefit nomination. But I mean, yeah, if they don't follow it, it would be maybe a management letter situation, but it's not necessarily a situation where you'd be noting a breach or anything like that.
No, I can't think of any sort of section of the SIS Act that, like a reportable section that we're responsible for. But it's going to be more a case of a disgruntled beneficiary taking the trustees to court. It's that kind of thing. It's not something the ATO would want us as auditors to look at.
Yeah.
Okay, so we'll close with one final question. So Graham has a situation where a couple aged 75 just got divorced. The court orders have transferred the wife's equity to the husband. The 30 June 2025 has been audited. What's now needed, i.e. a new set of accounts?
What do you think, Ben?
The wife's equity to the husband transferred.
I guess it depends what's the date of the court order.
Yeah.
If a court order is happening now, well, no, you don't need to go back and retrospectively fix it up unless there's something explicitly in the order that requires it. And if that was the case, then yes, you are sort of compelled. Well, the accountant and the trustees are compelled to go back and fix it, in which case it'd have to be sort of re-audited. Otherwise, it would just be something done now.
Yeah, but if it's happened after year end, the reality is if there's a divorce in a fund, we get stamped family court orders, for example. There will be something that relates to the superannuation fund, and all the dates and the timing of everything kind of needs to be followed. And if it occurred after 30th of June 25, and they're saying, well, this money needs to transfer to the husband, you just process it based on those dates. If it happened prior to 30th of June 25 and the accounts have been done, and for some reason the court orders weren't provided, then you probably need to amend the accounts. Yeah.
Okay, well, look, thank you so much. We have gone over and run out of time, but I'm so thrilled with today's session. It's been a tremendous turnout. Loved all of the questions. We will definitely continue this series, so keep tuned and we'll keep you posted. So Chris, Ben, thank you so much for your tremendous insights, and for everyone who tuned in today, thank you so much, and thank you for being so engaging. Till next time.
Thanks, everyone.
Thanks, guys.
Bye.